Our next guest, though, says we should be using a different word than recession to describe the current state or even the near future state of the U.S. economy. And that word is resilient. Joe Brusuelas, RSM chief economist, is with us now. Listen, I am curious for your view on what Rick was just talking about, but let's get into this resilience versus recession discussion first, Joe. So it sounds to me like you don't think a recession is indeed around the corner.
Well, we're not in one now, and our model says the first chance that we would fall into one would be early next year. So I would agree in general with what Rick said. You know, the $5 trillion put on the table was the first time the federal government's really used fiscal firepower in a significant way to alter the dynamics and trajectory of the American economy since the mid-1960s. Yeah, we got some inflation out of that, but I would argue most of the inflation we got was due to the supply chain shocks followed by the Russian war in Ukraine, in addition to the demand where we had too many dollars chasing too few goods. That $500 billion that we have sitting in excess savings right now, that's really the difference between an economy that's growing right around trend at around 1.8%, an economy that would be in recession. You know, if you take a look at the corporate sector, what do you see? Significant pullbacks on business fixed investment, that's productivity enhancing goods. But it's the consumption that's really driving things.
But Joe, if I'm sorry to interrupt, but what about what Rick was just saying about that new research that shows that excess savings is perhaps more quickly being spent down than is being factored in?
Without a doubt. I mean, we've gone from $2 trillion to $500 billion in a little over a year and a half. So it is being spent down. I think the real question is when we get to the end of the year, say CPI is around 3% and nominal wage growth around 4%. Well, you know what's going to happen is we're going to see spending continue to go forward because you got a 1% increase in real wages. At that point, you've got a very different set of dynamics and a very different discussion. Yes, those of us who work in and around financial services and financial markets will be inflation's above the target. We need to get back to target. But the best research, as you might know, is that once inflation is moving between 3% and 4%, consumers really don't care. It's more about financial markets. So this discussion will be dynamic and evolve as we go forward.
So as of right now, it doesn't seem like the economy is in a recession. I mean, you could easily look to employment and say that it's not. But at the same time, what are the metrics that you would be looking across to determine whether or not, NBER aside, to best determine if we are actively seeing signs of that?
All right, so if I'm stranded on a desert island in the South Pacific, and let's say I'm bored and I want to think about economics, finance, and the condition of the United States, the one metric that I would go to would be the 13-week moving average of initial claims. Right now, that tells us, yes, there's a little bit of an increase in layoffs, but we know that within 8 weeks, people are finding jobs. That's the median duration of unemployment. So we are nowhere near a recession right now, despite a very sour set of sentiment inside corporate America. And of course, the social and political polarization we have in the country, which really makes me not look at a lot of soft data these days, because I know they're just answering based on their preferences around the tribe.
Let's speak a little bit more about politics, though, and about tribe, because I am also curious to get your take, Joe, on something else Rick was just talking about, which is whether, especially that last piece of stimulus, did more harm than good, and how the repercussions perhaps are still being felt. What do you think?
You don't get that last piece of stimulus, we're probably in recession.
Mm-hmm. So I guess you do think it was necessary.
I do think it was necessary. Look, we're still dealing with, and will for years be dealing with, the shocks unleashed by the pandemic. We're 2.5 million workers short right now. You know, Julie, in the United States, it's hard for us even to have a discussion around why that is. Most of us have a good idea that it's the long tail of COVID, and it's knocked a lot of people 55 and older out of the workforce. Yet, because the social and political dynamics make that conversation very difficult, right? So when I see $500 billion on the table, that's going to get us through the last vestiges of the inflation shock and the interest rate shock. I think when we get on the other side of this, we're going to have a very different discussion, because right now it's difficult to talk about, right? Inflation is sitting at 4.9% if you use the CPI metric. It's going to be down to 3% by the end of the year. Then we're going to have some discussions around what's the appropriate Federal and Federal Reserve inflation target. Do we want to shoot for a different level of growth? And do we need that churn because we have all those baby boomers retiring? We're going to have to finance their Social Security and their Medicare. It's a very different discussion from the one we're having now. But one would think in 2024 and 2025, that's going to be one of the primary narratives around our economy.
Considering that we've been talking about recession for the better part of a year now, and we've continued to try not to fight the Fed, at least in the equity markets, but to best anticipate what they're going to do, what do you believe of the Fed credibility once we get through, or I guess we have to get to the next recession that has been impending and that we've been discussing for this length of time?
Well, there's going to be a period of time where the Fed's going to need to rebuild eroded credibility. What that means is they're going to have to move back to risk management and a focus on price stability. Look, price stability is a precondition of maximum sustainable employment. The Fed needs to not throw in the towel on that. While I think it appropriate that they pause at the June meeting and give it 2 or 3 months to assess the lagged impact of past rate hikes and notice the risk matrix around us, tightening lending by local and regional banks, and of course the debt ceiling. It's a good time to stop, but doesn't mean that it's permanent. Now, this is where a lot of the noise is going to be in financial markets, I think, this summer of will the Fed restart after that June pause? Look, if inflation's sticky, if we don't get the relief we're expecting inside the housing sector on rents, owner's equivalent rent, shelter, Fed's going to need to restart those rate hikes, and I would expect 1 or 2 more if that's the case. If we do get those big year-ago base effects, and it looks like we're getting down to 3 or even below 3 on CPI, and we're sitting at 3.5 to 4 on core PCE, well, then I think maybe conditions are right. The Fed will stop. That'll be the peak. And then watch, you'll see equity markets take off.
What do you think that places the real, then, at the end of this terminal rate at?
Well, I'm thinking that the geopolitical tensions around the world that are resulting in reshoring of work back to more friendly countries, back to North America, it will entail higher costs and require a higher interest rate. And instead of being 0.5% on the real rate, we're probably talking about 1 to 1.5%. So we're going through some structural change. It's very hard to identify in real time while you're in the foxhole, but I think that that's what's happening. That's one of the reasons why I'm in that camp, that when we get to 3% on the core PCE, we need to have an in-depth, full-throated, robust discussion on the appropriate interest rate target. And I think 3% makes a lot of sense because in order to get to 2%, we'd have to put just too many people out of work. To be honest with you, it can cause real problems because right now we don't have enough people to fill the jobs. Female labor force participation rate, 25 to 54, hit an all-time high at 77.5%. And that's well below the near 90% of the male cohorts. But I think that's the last bastion of people we can tap to pull back in the workforce, which entails another discussion around incentives, structural flexibility among private sector firms, and perhaps childcare financed in an international way. And these are big, big topics, but the conditions are changing rapidly, and we're going to have to evolve with them.
Joe, one more really quick point to go back to the idea that we might get a skip instead of a pause in the rate increases. Yes. How disruptive would that be for the markets? How much has it been historically when the Fed seems like it's stopping and then does another one on a delay?
Well, we're in Shakespeare's undiscovered country here, aren't we, Julie? This is a very different type of inflation. So I don't think there's any real precedent. We will all draw on the lessons of the stop-start monetary policy of the 1970s into the 1980s and say that was a bad idea. But is that the best analogy for where we're at now? And I don't think so. Again, I think it's appropriate that the Fed pause. We're going to hear from Jay Powell in a few minutes. He's going to sound a lot like he did in his presser following the last FOMC meeting. But my sense is we're going to get some good news on June 14th when the Fed releases its forecast. I guess my sense is they're going to upgrade the forecast for this year, so it won't look like an inflation is imminent. Then we can have a much more nuanced discussion around the evolution of the path of monetary policy. And indeed, the Fed may need to pull back on its quantitative tightening program because after we get through the debt ceiling, Treasury's going to have to flood the market with money. And you're going to want to watch the repo market as the canary in the coal mine. around some near-term disruptions once we get through the artificial political crisis that's been induced.
Joe, thank you so much. Really interesting stuff to keep a watch on, including, thank you for the reminder, we are going to be hearing from Jay Powell as well as former Fed Chair Ben Bernanke in the next hour. Joe Brusuelas, RSM Chief Economist, thank you. Appreciate it.